You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at Zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Investors were cautious this week at the outset of earnings season, and especially ahead of a key September jobs report. On Tuesday, the Dow closed at its highest level since May, putting it within points of that psychologically important 11,000 trading level. A better than expected report from the Institute for Supply Management this week backed the notion that the U.S. economic recovery is in fact gaining some traction, while a rate cut in Japan bolstered the view that central banks would step in if needed to support the global recovery. And some of the downgrades that hit the market this week tagged the technology sector. And it was reported also on Friday morning that the economy unexpectedly lost 95,000 jobs in September, making it the fourth straight month of losses, but the overall unemployment rate was unchanged at 9.6%. I'm going to bring back Kevin Matris now, our top market technician, who hasn't been here in a while.
How about that?
But you're back.
Back again.
Last time we spoke with you, you were looking at 10.7 on the Dow as a resistance point, and you said if it broke through, we would see a strong rally from there. Well, guess what? It broke through.
Yeah, it did.
So now what?
Well, you know, here we are. We are at 10.9, and I'm actually expecting a lot more. I think the last time we were here, I pointed out a pattern on the chart called a head and shoulders. So check it out.
Yep.
I had said that if we can get through that 10.7, and then if we break through the upside of this head and shoulders pattern, I thought we could get as high as like 12,000. And here's where that chart is projecting. And personally, I think this is where the market is headed. All
right, even with all the concern out there?
You know, it's interesting because there are a lot of concerns out there. There's been a lot of disappointing news in the last few months. But the market has been exceptionally resilient. And if the market is able to keep itself intact even during all of this disappointing news, in my opinion, that shows the market has a lot of good support. And it's almost as if the market is just kind of waiting for a little bit of good news to rally. But the one thing that hasn't been disappointing is corporate profits. Corporate profits literally are at record highs. And this is why you're seeing top-line sales growth slow because the consumer is kind of weak and the economy has slowed down. But just imagine how corporate profits could explode even more once the consumer gets back on his feet and once the economy starts doing a little bit better. So personally, I think the upside is being significantly underestimated in the media. I think there is a lot more room to grow.
All right, we're going to circle back to you on that at the roundtable a little bit later on. Right now, though, give us, if you would, some weekend wisdom on what two main things investors need to know about today's market before they make their next trade.
You know, there's a lot of things to know to prepare for how you're going to invest in the market. This old adage that knowledge is power couldn't be more truer when it comes to investing. But two takeaways I would say is this. For one, I would say focus in on the best industries.
Okay.
You know, it's an old adage out there that 50% of a stock's price move can be directly attributed to the group that it's in, and it's true. And what I have found is that even a mediocre stock in a top group will oftentimes outperform a top stock in a crummy group. So you definitely want to focus in on the top groups. The second takeaway is everybody right now is looking for growth. But while everybody is searching for growth, a lot of people are looking for the ones with, you know, triple-digit growth rates. My studies have shown that stocks with double-digit growth rates actually perform better than stocks with triple-digit growth rates. Okay. And the reason why I think that is because it seems kind of counterintuitive.
It does, yeah.
But the reason why I think that is because those kinds of companies are priced for perfection. And even the slightest earnings estimate revision downward can ruin that stock. So a lot of people think how in the world can my 300% growth stock possibly be going down? That is why it could be going down. So I would say focus in on the top industries, focus in on the top stocks within those industries, but I would much rather focus in on a double-digit growth rate because there is a greater chance that that kind of growth rate will continue.
Yeah, counterintuitive or not, I knew you'd be able to explain it. That's why I was just kind of letting you go there on that one. Anything standing out on your radar for the week ahead as far as the markets?
You know, it's funny because we did have the employment report today, but the market has kind of shrugged it off. It's actually up while we're talking.
Well, we had it on Friday.
Well, yeah.
By the time they see this, it's not today anymore.
Well, but yeah, so the market is up a little bit. Of course, we're going to see how the week ends, but personally, I think the market is putting in a nice base, and I think the market, like we said earlier, is really getting ready for the next leg up. These crummy unemployment numbers can't last forever, unless they can, but I don't think they will. So I'm expecting good things for the weeks and the months ahead.
So you're actually looking for the market quickly to carry the steam up through into the new year.
As we said, I think that the market has enough momentum to get up to 12,000.
All right.
So yes.
Thank you for that. We'll see you a little bit later on. There's more still ahead. Stay with us. Here is your Bull and Bear Stock of the Week. A multi-line insurance company and a retailer make up this week's Bull and Bear of the Week. Shiraz Mian, Research Director, here with us once again to give us the particulars on why each is what they are, if that made any sense to you. First, the Bull of the Week, Cigna Corporation, CI, the ticker symbol. That's the multi-line insurance company.
That's right.
Give me some reasons here that it's a bull.
Two main reasons, Terry. It's primarily a health insurer. About 3/4 of their revenue come from health insurance.
Okay.
A bunch of changes in that space after the healthcare reform. And folks have been kind of wary of coming into this group and this sector. Cigna has the least exposure to the negative consequences of the healthcare reform changes, and that is the primary reason for my pick of the stock. Okay. The second reason is their international operations, which gives them a fairly robust growth outlook outside of the U.S. market. So it's quite unique in the healthcare space, relatively smaller than some of the larger peers, but that smallness in size, if you will, has positioned them better to operate in this environment than some of the others. The least risk exposure that I referred to earlier, that's for two main reasons. Number one, the healthcare reform legislation is expected to have the most negative consequence in the individual and small group insurance market. United, Aetna, and WellPoint, those folks that are much bigger than Cigna generate anywhere from 15 to 30% of their earnings from that segment. Cigna generates less than 1%, so very small exposure to the individual small group segment. Second is the Medicare Advantage program, and again, Cigna has very small presence in the Medicare Advantage, and it's this lack of exposure to the negative consequences of the healthcare changes that has kind of made Cigna a safe bet in the health insurance, in the managed care space, and that's again briefly on the international growth opportunity. About 11% of revenue comes from the international operations right now, primarily Asia, South Korea, Taiwan are big opportunities. The expectation is that this segment could grow to 15%. Eventually 20% of total revenue. Okay. So a good growth opportunity there too.
Let's move on to the retailer, Regis Corporation, RGS, the ticker symbol. Why is this not a good stock?
This is a hair salon, about $1 billion in market cap, the largest in that space. It's tied into the overall stress and pressures in the consumer space. So two main reasons. Number one, the same reason as we have been highlighting and featuring for the other other retailers, meaning the pressures on the consumer economy, and number two, the consequences of that for the hair salon industry in general and for Regis in particular, the duration between visits for customers for Regis have been steadily extending, and you would expect that in a stressed out environment like this one. This is weighing on their same store comps. It's weighing on their top line, and it's weighing on their margins. We are seeing that in the estimates. We have seen that in the results for the last quarter as well, and I expect that to continue.
We're going to leave it there. We're screening for stocks next. Haven't done that in a while. Stay with us. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. This time around, we're talking about screening for PEG ratio with top stock screener Kevin Matris, who joins us here. We haven't talked about this in a while, or are you just giving human names now to this stuff that you do?
Yeah, I've been reduced to that.
Yeah, that's where it's all gone.
Right. No, PEG in this case, it is a what, not a who. And the PEG ratio, it is a great ratio for determining a company's under or overvaluation. So let's start off with a definition. PEG ratio is the PE ratio divided by the growth rate. So a value of 1 or less is considered good, which is at par or undervalued, while a value of greater than 1 in general is not as good or overvalued. So many believe this ratio tells a more complete story than just the PE. So for example, check this out. Company with a PE ratio of 25 and a growth rate of 20 would have a PEG ratio of 1.25. So that's 25 divided by 20, that's how you get your 1.25. But if you've got a company with a PE ratio of 40 and a growth rate of 50, that would have a PEG ratio of 0.8.
But that item seems to go a little beyond PE ratio.
Yeah, it really does because, based on this example, investors traditionally would look at the stock with the lower PE ratio and they would deem that one the better bargain, i.e. being undervalued. But if you look at it closer, you can see it doesn't really have the growth rate to justify the PE. The stock with the PE of 40 is actually the better bargain because it is lower on the PEG ratio scale of 0.8, implying it's undervalued with more potential for growth. It is undervalued in comparison to its growth rate.
All right, let's get to the parameters.
Yeah, the parameters for this screen is pretty simple. First off, I just want to reiterate the lower the PEG ratio, the better.
Right.
But for this screen, we are starting off with an average broker rating, and we want it to be less than or equals to 1.5, so all of the brokers have to be on board. Then we want the average broker rating change over the last 4 weeks to be greater than 0. In other words, they all have to have seen their stock recently upgraded by the brokers covering it. We want the projected 1-year growth rate to be greater than or equals to 20, so we're looking for outperforming stocks on that metric.
Got it.
The PEG ratio, of course, the centerpiece of this screen, it has to be less than 1, so it is a classic valuation metric, and then all of these values are being applied to stocks with a price of greater than $5 and an average daily volume of 100,000 shares or better.
All right, how many stocks came through?
There was about, I think, 35 stocks that came through, and here's 5 of them today. You've got Affiliated Managers Group, Creighton Performance, McCary Infrastructure, C-SPAN Corp, and Viro Pharma, a very diverse set of industries, but all of these companies have big growth rates and PEG ratios that are below that magical 1 level.
And I always ask this, or I have been recently when you and I get together to talk about screening, does this particular screen always produce a diverse set of industries represented?
Yeah, it usually does. Now, if you really want to, you can screen specifically for, a couple of stocks in each industry, but it usually gives you a very diverse set.
Interesting. And about how many times a year would you run this, or is there no set?
If you're trading it as a trading strategy, you would probably want to consider running this either at least once a week, or maybe once a week or at least once a month. But you can just run it all the time if you just want to get good picks to put on your watch list.
All right, thanks for that. Kevin is back with us at the roundtable. Stay with us. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Unemployment data, earnings season, the stock market rally. We're talking about it all here, and we're talking about it with our panelists, Shiraz Mian, Research Director. Kevin Matris is back at the round table with us, top market technician, and Tracy Reinick. You know her, she's been here for a few weeks now, equity strategist. So we're going to start with you. We got word on Friday morning that the economy unexpectedly shed 95,000 jobs in the month of September. This now, some say, fuels talk and speculation that when the Fed meets next month, they are definitely going to have to add more stimulus. Are you one of those people?
Yes, I agree with that assessment. The report that we got on the payroll did not really resolve or address any of those lingering issues that the market had been grappling with. So that the economy lost more jobs, that we had just a small amount of private sector job additions. It's no news. We had been seeing that for months and months now.
Fourth straight month, yeah.
And the market effectively has zeroed in on the so-called jobless growth. And it doesn't resolve those issues about the growth momentum of the underlying economy as well. So we are back to where we were before this report, which was that the economy was losing momentum and the Fed could come in to prop it up. So if it had been much weaker than what the market was anticipating, or had it been much better than what they were anticipating, then we could have had some question mark on the Fed's outlook, but it came just roughly in line with expectations, meaning that the expectations that were building up for the Fed, they remain in place and they will continue to remain in place.
All right, so if the Fed now, Kevin, has to act, they have to step in, put more stimulus to get this economy going, is that going to happen sooner rather than later, or might they wait till December to do that, do you think?
I think they may wait. First off, you know, the headline number on today's or Friday's report, yeah, it was kind of bad, but a lot of that was because of government jobs being lost. But if you do look at private payrolls, they were up 64,000. Is that some huge, spectacular number? No, but it was a good enough number, and the market seemed to have embraced it enough.
So if there's more Fed easing, I want to circle back to something you said at the top of the show. If there's more Fed easing, then what does that do? Does that even give more support to the stock market rally?
You know, I read a story earlier this week, and you know, some of the Fed governors, they're going to go in with an open mind, but they had said that they would prefer to kick the can down the road at least for a couple of more meetings, because while it is true we are seeing growth slow, it has not slowed as much as they had feared. So they want to get more economic data coming in before they actually take action.
But if they do step in, is that going to help boost stocks?
If they step in the way they stepped in before, I don't think it's going to have much of an effect.
Okay.
So I don't know.
All right, Tracy, we're in another earnings season, and earnings are expected to be strong across the board. What do you think?
Well, we haven't seen a lot of prior warnings. So I say, yeah, I think we're going to see some good numbers. We're already seeing some good numbers out of a lot of companies, especially those that have international business or that are on the commodity side. I kind of disagree with actually what Kevin was just saying about.
And it's your right to do so.
How dare you?
I know about well, I had to disagree now that you're back. Nice. But now that the Fed, you know, they've already been signaling that they're going to do the easing. Why wait until like December or January? They already have all this data coming in, and look what it's doing to the commodity sector. I mean, do they want gasoline at like $4 a gallon? That's going to do the opposite of what they hope to do with the easing. So you're going to have all these other things in play, and I don't think they're going to wait at all.
All right, let's get back to earnings. Sectors, you started to talk a little bit about sectors. What about stocks in corporations in the emerging market areas?
Well, that is the hot area because we still see the growth that we don't have in all of these other countries like Brazil and China, and they've been, you know, raising interest rates in these other economies to try to contain the growth to some extent and contain inflation. So yeah, I think anybody who has business there, especially in like agriculture again, or the commodities, or we're even seeing it with like Yum Brands, who said that, you know, the Chinese growth story is still there, will be reporting good numbers, I think, this quarter.
And we've had some volume come back to the market, another good sign.
That's
the
right.
Financials trying to participate, but they're doing it in fits and starts. Are we going to see more participation on the part of the financials here going forward?
I think so, yeah. Many of those issues that were keeping the financials on the sidelines are clearing up now. We didn't know how the regulatory landscape in the U.S. will be post the legislation. There was a lot of uncertainty about what the global minimum capital requirements issues would be. And we have a lot more clarity now than we had 3 to 6 months back. So there's still some issues. We still don't know when these companies, the financials, will come out and reinstate the dividends that they cut during the downturn. And that's the remaining sticking point right now.
All right, so stocks, very quickly, yes or no? Stocks, the place to be?
Stocks the place to be,
Okay.
and stocks would benefit from quantitative easing.
Then if you believe that, give us your top stock pick of the week.
Dollar Tree. I think the stress and pressures in the consumer economies remain in place, and Dollar Tree is a discount retailer which stands to benefit from this environment. It's gaining traffic and it's showing up in its top and bottom line.
Got it. Kevin?
Additional quantitative easing notwithstanding,
Yeah.
I still believe stocks is the place to be. Anyways,
Okay.
my
All right.
pick,
Spit it
my
out.
pick is Actuant Corp, ticker ATU. They are in the machine tools and related products industry.
Okay.
What's interesting is that they are a top stock in a top-rated industry. We talked about that earlier. Their industry is in the top 4% of industries. Out of all the industries out there, they have great growth rates, attractive valuations. I think that is a great place to be.
All right, Tracy, quickly.
Rio Tinto is mine. As I was talking about the commodities, they're a huge mining giant. They are in every single commodity. So as commodity prices go up, they should see their earnings, do some good things here. They're supposed to double their earnings versus last year already, and they're pretty cheap. They're trading at only a little bit over 8 times earnings. So the commodities are a good place to be.
Yeah, commodities are having some weird things going on with them right now.
Well, yeah, because it's all about the quantitative easing. It depends on, what's going to go on with that. But, a lot of them are at record highs, copper, tin,
Right.
gold, obviously, and Rio Tinto is in all of those sectors.
All right, thank you all for being here. Welcome back. Stay there, don't be a stranger anymore. Thank you for being here with us as well. We'll see you next time on Profit from the Pros.